Joining us now, Jurrien Timmer, Director of Global Macro at Fidelity Investments. Jurrien, great to have you with us. Where do you stand on where we are? Record highs, basically.
Well, the episode of the last 6 months shows just how brutally efficient the price discovery process is in any market, but especially in the U.S. stock market. And so we went from a right tail scenario after the election to a moderate left tail scenario in April, and we're back to a right tail scenario, in July. And assuming, we don't know what's going to happen with the whole tariff tantrum, whether it revives, but I think the markets are taking a wait-and-see attitude after the back and forth lurching of the headlines back in April. And you look at the big, beautiful bill, you look at earnings estimates having been haircut by about 500 basis points from 12% expected growth in 25 to now 7. We got earnings season, of course, coming up next week. So I think there's a good chance that the earnings numbers will actually start to come back up again. And I think the market is pricing that in at a 23 multiple. So I think the market's in good shape. The breadth numbers are good, above the 200-day moving average, about 65%. So I think the overall health of the market is pretty good, and industrials and financials and consumer stocks are joining in with tech and communication services. Even global markets are at a new high. So it's a good situation. The downside, of course, is that if we do actually get the tariffs that were warned back in April and then were taken off the table a few weeks later, that could depress profit margins or increase consumer prices to some degree. I think this is why the Fed is on hold, which in my view is the right thing to do. And of course, we got that 10-year yield, right? Nothing good ever happens above after midnight, but nothing good happens above 4.5, and we're at 4.4. And so that maybe become the most important indicator to watch here.
Are you surprised by the 10-year yield remaining pretty firmly in a range here? We're actually lower than where we started at the beginning of May, for instance, on the 10-year yield, despite the big, beautiful bill, despite all the concerns about the deficit, despite concerns that foreign investors are stepping away. We had a very good 30-year auction yesterday.
Yes, I'm fairly, pleasantly surprised that the 10-year is holding below 4.5, because again, when it goes above 4.5, we saw this in the fall of 2023 and other times as well, the market starts to wobble. And this is the old Fed model from the Greenspan era, right? When the risk-free asset, treasuries, are yielding roughly the same as the risky asset. So you got, treasuries at, let's say, 4.5. The S&P, if you invert the PE, you're about 4.5. When they're equally priced and the yield goes up, the stock market has to compete. That's what the Fed model is about. And so I think staying below 4.5 is very important for the health of the stock market, let alone the bond market and the whole fiscal situation. But yes, I've been surprised how well maintained that level has been, a range of, let's say, 4 to 4.5. Anytime it goes below 4, it pops back up like a beach ball held underwater. So clearly there is a limit to how low they can go. But I do think the investors come out at 4.5, and I think speculation about what the Treasury will do with its refunding announcement and to what degree that 4.5 level can be backstopped by Treasury issuances or stablecoin reserves. There's all kinds of elements there that are at play, including what the Fed will do in terms of switching its maturities around in a waiting game for the Fed to cut, which I don't think is coming imminently. But eventually the Fed does have room to cut a few times, but not much more than that.